Good morning and welcome to TOI Japan Market Radio. I'm coming to you from Tokyo on Saturday, June 13, 2026. This is your daily briefing designed for global investors tracking Japan's equity, currency, and fixed income markets. Today we're unpacking some significant price action driven by geopolitical developments in the Middle East.
Thanks for having me. Before we dive in, it's worth noting that Japanese markets were actually closed today for a public holiday. However, the news flow surrounding Japan has been exceptionally volatile, and it's critical for anyone with Japan exposure to understand what happened in the lead-up and what Monday's open might look like. We saw conflicting headlines over the past 24 hours. First, a major sell-off on rising oil prices and Middle East tensions, then a sharp reversal as those tensions appeared to ease. So we're dealing with a market caught between risk-off and risk-on sentiment in a very compressed timeframe.
Let's start with the initial shock. Earlier this week, we saw a headline that the Nikkei plunged over 5% on a crude oil surge tied to escalating Middle East concerns. That's a significant one-day move by any measure. Walk us through what drove that.
Absolutely. The catalyst was a sharp spike in crude oil prices, triggered by fears of supply disruptions out of the Middle East. When oil prices surge like that, Japan is one of the most exposed developed markets. Remember, Japan imports roughly 90% of its oil, and a large portion of that comes from the Middle East. So any disruption risk, whether it's geopolitical tension near the Strait of Hormuz or broader regional instability, immediately hits Japanese corporate margins, especially in transport, chemicals, and utilities. It also pressures the trade balance and raises inflationary concerns.
And that 5% drop in the Nikkei, was it broad-based, or were certain sectors hit harder?
It was broad-based, but cyclicals and energy-intensive sectors underperformed. Exporters also took a hit, even though you'd normally expect a weaker yen to support them. The problem was that the magnitude of the oil shock overwhelmed any currency benefit. Investors were pricing in earnings compression across industrials and consumer discretionary names. If oil stays elevated above $80 or $90 a barrel for any sustained period, you're looking at companies having to revise full-year guidance downward. That's a real risk for the TOPIX as well, given its heavy representation of these sectors.
On the currency side, how did the yen react during that sell-off?
The yen actually strengthened modestly. That might seem counterintuitive given the negative implications for Japan's economy, but it's classic risk-off behavior. When global investors get nervous, they tend to buy safe haven assets, and the yen remains one of the primary safe havens globally. So even though higher oil prices hurt Japan's current account over time, in the short term you saw flows into the yen. That dynamic can create a headwind for Japanese exporters, who benefit from a weaker currency.
And Japanese government bond yields, what happened there?
Yields fell modestly. Flight to quality demand pushed investors into JGBs, compressing the long end of the curve. That's supportive of the Bank of Japan's yield curve control framework in the near term. But there's a longer-term complication. If oil prices stay elevated, you get stagflationary pressures, meaning higher energy costs without corresponding growth. That could create mixed signals for the BOJ and complicate their policy trajectory.
Now, staying with the Middle East theme, we also saw a headline about Japanese stocks sliding on a tech pullback as Iran tensions deepened. It sounds like technology was a focal point in that sell-off.
Exactly. Japan's equity indices, particularly the Nikkei 225, are heavily weighted toward technology and semiconductor exporters, names like Sony, Tokyo Electron, Advantest, and the broader chip supply chain. When you get a global tech sector pullback combined with geopolitical risk, those stocks get hit from both sides. The Iran-related tensions added a layer of risk-off sentiment that depressed valuations on growth stocks. Tech is a momentum-driven sector, so once selling starts, it can accelerate quickly.
And the geopolitical risk itself, how does that specifically channel into Japanese markets beyond just the oil price?
There are multiple channels. First, you have energy security concerns for a resource-poor country like Japan. Second, there's the risk of shipping route disruptions through the Strait of Hormuz, which is critical for oil tanker traffic. Third, broader risk aversion depresses valuations across the board, particularly for growth stocks and exporters. When investors are worried about geopolitical instability, they pull back from cyclical exposure and move into defensives or cash. That's particularly painful for Japan given how much of the index is cyclical and export-oriented.
But then, shifting to the more recent developments, we saw a very different headline: Asian equities surging and crude plummeting as easing Middle East tensions sparked a risk-on rally. So it seems like the situation reversed quite dramatically.
It did, and this is where it gets interesting for global investors. The geopolitical situation appeared to de-escalate, at least in the near term, and crude oil prices declined sharply. That triggered a broad risk-on rally across Asian markets. For Japan specifically, this is a major positive on multiple fronts. Lower crude prices reduce input costs for energy-intensive industries, which improves profit margins. It also eases inflationary pressures, giving the BOJ more flexibility in its policy decisions. And it supports the trade balance by reducing the import bill.
So if markets were open today, you'd expect the Nikkei and TOPIX to rally strongly on Monday?
That would be the base case, yes. Risk-on sentiment typically lifts Japanese equities, especially cyclicals and exporters. The energy cost relief is a direct positive for manufacturers, utilities, and transportation companies, all of which are key constituents of the Nikkei. You'd also expect sector rotation into more cyclical names as investors price in better margins and lower input costs. The question is whether this de-escalation holds or if we see another flare-up in the coming weeks.
What about the yen in a risk-on environment?
The yen would likely face some headwinds. Risk-on rallies typically weaken safe haven assets, and the yen is no exception. A weaker yen would actually be supportive for Japanese exporters' competitiveness, so you could get a double benefit: lower energy costs and a more favorable currency backdrop. That's a pretty attractive setup for Japanese equities if it persists.
And on the rate side, any change in JGB yield expectations?
You'd expect modest upward pressure on yields from the risk-on rally as investors rotate out of safe haven bonds and into equities. But the dominant longer-term factor will be the BOJ's policy response to lower inflation. If crude prices stay low and inflationary pressures ease, that gives the BOJ more room to maintain its accommodative stance or even delay any normalization steps. That could keep long-end yields anchored, even in a risk-on environment.
So putting this all together, what's the key takeaway for global investors monitoring Japan exposure right now?
The key takeaway is that Japan is highly sensitive to Middle East geopolitical developments because of its energy import dependency. We saw that play out in real time. First a sharp sell-off on oil price fears, then a rally as those fears eased. For investors, this means volatility is likely to remain elevated as long as the geopolitical picture is uncertain. But if the de-escalation holds, the setup for Japanese equities is quite constructive: lower energy costs, supportive currency dynamics, and continued BOJ accommodation. The sectors to watch are cyclicals, exporters, and energy-sensitive industrials.
And just to be clear for our audience, we're not providing financial advice here. This is market commentary designed to help you understand the drivers and risks in Japan's markets. If you're actively managing Japan exposure, it's worth keeping a close eye on both the geopolitical developments and the domestic policy response from the BOJ.
Absolutely. And one other thing, given how quickly the narrative shifted from risk-off to risk-on, it's a reminder that positioning and timing matter a lot in these environments. Investors need to be nimble and understand the macro drivers, not just the individual stock stories.
Great context. Thank you for breaking that down. If you follow Japan's markets and found this useful, consider subscribing to TOI Japan Market Radio. We'll be back with more updates as the week unfolds. Thanks for listening.